Hello, I'm Nadine Blayney, and joining us today are Andy Sharp from Altere Financial and Jason Yeh, who's joining us from S&P Dow Jones Indices. Now, they're joining us to discuss how some advisors are using indices to inform income-seeking clients as they plan for the future. Andy, Jason, welcome.
Thank you.
Jason, I might start with you, though, because maybe you could tell us how the indexing landscape has changed when it comes to benchmarks tracking income generation, of course, and how that's changed the Australian market.
So we observe a dynamic change in the income-oriented indices globally. And part of that is driven by the interest rate and inflation regime. So prior to 2021, as the global market has been in a long cycle of lowering interest rate, income-seeking investors, they turn to yield from the equity space. So this turn has triggered the growth of dividend strategies. And since 2021, as the US Fed aggressively raised the interest rate, the fixed income yield became more normalized, and there's also a lot of talks about the fixed income indices as well. However, the demand of the dividend indices is still growing. And we also have seen others interested in alternative income strategies like the covered call strategies. The Australia equity market is still a relatively high yield market compared to the rest of the developed markets. The dividend yield of the S&P ASX 200 index for 2024 is around 3.7%, which is higher than the 1.4% of the S&P 500 as April 30, 2024. So it's certainly a market to pay attention for income-seeking investors globally.
Andy, now maybe you could tell us how the financial planning industry has changed really in the decades since you've been, in the financial advice business.
Sure. Well, about a little over 20 years ago when I came into the business, I was trained as a broker. So we were incentivized to solicit a transaction, whether buy or sell from a client. We were paid a commission, and that was how we generated our revenue as advisors or brokers. Right after I came into the business, I saw a shift in the training. No longer were they teaching trainees to sell stock. They were actually teaching them on how to run a financial plan. So we saw this shift away from commission-based brokering to advice-based models. And that's when we really saw the emergence of mutual funds and ETFs in a much more advanced manner. Now we were building diversified portfolios, which were really focused on. Now we went through such events such as Enron, where we saw clients really lose a lot of their wealth sticking into one stock. So it wasn't just enough anymore to be the best stock picker. We had to go to another type of advice level and really prepare clients with a diversified client portfolio, teaching them actually how to match their liabilities with the portfolio and having it work for them in a much longer basis.
So Andy, given all that, where do index-based strategies fit in terms of conversations with clients seeking income?
Yes, great question. So the nice thing about index-based strategies are now there's so many different options to choose from to generate income. So we know not everything's going to be performing the way we want it at one time within a portfolio. Sometimes the assets aren't growing. Other times there's not a lot of high income in the portfolio. So indexes have given us the option now to blend several strategies together to generate more of a total return approach. That's growth and income in the portfolio, which then helps us get clients the income they need overall in matching their longer term planning needs.
And presumably to help keep up with inflationary pressures as well.
Absolutely correct. Absolutely correct. Because again, when inflation's high, yields and fixed income are, but we see depreciation in the price as well. So how do you offset that? The income's good, but then we have to keep up with rising prices. We can do that on the growth side with ETFs as well.
Jason, can you then share some insights into some of the indices that are helping with income generation for Australian investors?
Sure. As I mentioned before, the two types of income-oriented indices that have been growing in the market are dividend and buy-right indices. And Australia is a relatively high-yield equity market. To respond to the market demand, S&P has launched the S&P ASX 200 High Dividend Index in June 2023, and the S&P ASX 200 Buy-Right Index was launched back in 2004, and we did a methodology change in January 2023 to reflect some of the new parameters in the marketplace. So let's start with the S&P ASX 200 High Dividend Index. The index seeks to measure the performance of 50 companies with a high dividend yield from the S&P ASX 200 universe. Here is how the index is constructed. First, we start from the S&P ASX 200 universe, exclude all the REITs and stocks without a positive 12 months forecast dividend yield. Second, we calculate the momentum value of the stocks. So momentum is essentially the past 12 months skipping the most recent month's price return, adjusted by volatility. And then we exclude the companies ranked in the bottom 10% of the momentum value. Third, we select the 50 stocks with the highest 12 months forecast dividend yield while capping number of stocks from any gig sector at 15 maximum. Lastly, we weigh the stocks by the product of the dividend yield and the float market capitalization. And in addition, we apply stock and sector capping to avoid concentration risk. The index is rebalanced semi-annually in January and July.
Tell us a bit more about the S&P ASX Buy Right Index and perhaps even how it has performed historically.
Yeah, so the buy right strategy, or so-called covered call, essentially sell or write call options against shares of assets that they already own to generate income from the option premium. So in the S&P ASX 200 Buy Right Index case, it holds a theoretical long position in the S&P ASX 200 and a theoretical short position in the quarterly S&P ASX 200 at-the-money call options. The long position in S&P ASX 200 component and the short call option component are held in almost equal notional amounts so that the short position in the call option is covered by the long position in S&P ASX 200 component. Each quarter, depending on if the S&P ASX 200 ended the quarter above or below the strike price of the call options, the contract may or may not be exercised. In either case, the option premium from selling the call options would contribute to the total return of the buy right strategy. The theoretical payoff of the S&P ASX 200 Buy Right Index may be different in down and up market. So in the down market, when the long position in the S&P ASX 200 will suffer from the index level decrease, the option premium from selling options may compensate part of that loss to some extent. In up market, if the S&P ASX 200 increase exceed the strike price of the call options, then the options will be exercised. And thus the index strategy will keep the option premium but will not benefit from the entire increase in the index value. Overall, since June 1st, 2004, the performance of the S&P ASX Buy Right Index has been 8.91% per annum on the total return basis, which outperforming the S&P ASX 200 by 10 basis points per year. The outperformance also comes with 9.38% of annualized volatility, which is significantly lower than the 13.85% of the annual volatility for S&P ASX 200 index.
Jason, and again, I'll ask just for the detail, what are some of the potential advantages or disadvantages of an indexed covered call strategy?
Yeah, so the potential benefits are come from threefold. First, it could provide yield, right? It's a systematic long-term covered call strategy that generates an income stream through the accumulation of option premiums. And that strategy keeps option premiums regardless of market movement, which will helpful to increase the yield of the overall strategy. So since its launch in 2004, the index has achieved an average quarterly theoretical option premium yield of 2.94%. Secondly, it could also provide a downside protection to some extent. So in a bear market, call options are unlikely to get exercised. In addition, the risk premium typically will rise as the market volatility spikes during the market crisis. The theoretical income generated from selling options are partly offsetting that declining index price. And thus, the covered call approach has tended to outperform the S&P ASX 200 in down markets. And finally, the S&P ASX 200 Buy Right Index has been less volatile than the S&P ASX 200 Total Return Index historically. The consistent reinvestment of option premiums has historically helped reduce the volatility of the covered call index compared to its underlying. For the past 10 years, from March 2014 to March 2024, the annualized volatility of the S&P ASX 200 buy rate was 9.89%, lower than the 13.99% of the S&P ASX 200 total return index. But these benefits, they do come at a cost. So the S&P ASX 200 buy rate index forfeit the upside potential of the S&P ASX 200, as it is obligated to sell the asset to the buyer of the option if it is exercised. So during the periods of strong rallies, the S&P ASX 200 buy rate index tends to underperform the S&P ASX 200 total return.
Really interesting. And I suppose, Andy, that brings me to you because, some of these strategies may take investors out of their comfort zone when it comes to terminology, at least. So how do you help educate your clients when it comes to indexing and help them understand how some of these strategies can be utilized?
Yes, so it first starts with the education of everything that comprises the investment. So if I'm going to be discussing an index that has a buy rate strategy, I first discuss what an index is and why that may be advantageous to an active strategy. So we could start with the SPIVA scorecard and explain, hey, indexing has had its benefits over years versus maybe what you're used to. And then we start to discuss then, okay, now that we have the index set, how does the index actually put together? I have to build confidence with the client that this index just isn't a list of random companies, that there is a methodology that goes in actually building this index. So you can see I'm building up to the point, now I'm going to introduce what actually a covered call is. And to illustrate that point, usually I like to, let's say pick a US company when I'm working with my US clients, give a well-known name, and say, here's what a call option actually is. Okay, there's somebody on the other side willing to bet that the stock you hold will hit a certain price. And if it hits that price, you are then obligated to give them the stock at that price. But if it doesn't hit that price, guess what? You keep the income. They can understand that. They can relate to large names in the US. And then I say, well, guess what? There's a strategy now that will take the top 500 names in an index that you trust in the US and write covered calls on that index. That makes it much more relatable to the client to understanding. I build it up in a structured way to educate them along the whole way in the process. The final step then is showing how does this actually help them potentially in their portfolio, whether it's enhancing the income or slightly reducing the overall volatility. Once I educate them, then I have to show them why it actually fits and what they're trying to do.
Andy, Jason, thank you so much for joining us. Now, to find out more about how indexing is supporting advisors and helping their clients to plan for income strategies, and to access S&P Dow Jones Indices research and data from across Australia, please visit the link on your screen below.